The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Elusive peace talks, persistent inflation, sapping conviction in the record stock market rally. Live from Studio 2 here in Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Isabel Lee. We're kicking you off to the market close on this Tuesday here in the U.S. And this is where we stand. We're looking at an S&P that's edging lower for the second straight day. Lots of headlines to digest today, Romaine. We have the Senate testimony hearing of Kevin Warsh, and we also have the current state of the peace talks over at Iran. Brent crude extending gains up by more than 2%. We have Commerce Bank saying that they expect Brent crude per barrel to be above the $80 mark. 10-year yield, we're looking at 4.28. And Apple, without a doubt, this is the stock of the day. This is a stock, a $4 trillion company that's long held by Tim Cook, and it's now going to find a new leader in John Ternus beginning September 1. And under Cook, though, it has had a great run, 700% in profit growth and also more than 500 stores worldwide.
All right, we go back to the S&P here because we're looking right now at the first back-to-back losses for the benchmark index in 3 weeks, correlated with the biggest back-to-back jump in oil prices in 5. The optimism around Iran peace talks waning as U.S. negotiators appear to have been rebuffed by Iran with just about 24 hours before the expiration of a ceasefire that had sparked that record-breaking rally. So today's price action, well, just like yesterday's, it appears to be a test of conviction. There is upside support from decent corporate earnings and a solid retail sales report for March, even in the face of what has been the sharpest surge in gasoline prices in about 2 decades. But the downside drag, well, it's starting to set in with stocks in overbought conditions, trading volume more than 10% below that 6-month average, and a measure of investor sentiment compiled by Barclays that's declining. The dog and pony show on Capitol Hill, also a bit of a distraction as well. The Senate confirmation hearing of Fed Chair nominee Kevin Warsh largely centered around his credibility on fighting price inflation. Inflation that has been running above the Fed's 2% target for 5 years and counting, a streak that could continue if Warsh kowtows to the rate-cutting demands of the man who nominated him, despite all better economic judgment.
Are you going to be the president's human sock puppet?
Senator, absolutely not.
Are you going to be anybody's human sock puppet?
No, I'm honored the president nominated me for the position, and I'll be an independent actor if confirmed as chairman of the Federal Reserve.
And probably the quote of the day from that Senate confirmation hearing. Joining us here in Studio 2 in New York is Bill Dudley, the former New York Fed president and now a columnist for Bloomberg Opinion. Bill, great to have you here.
Great to be here.
You know, about a week ago, I think you were on Bloomberg Television, and you talked about how Warsh really needed to win the hearts and minds of these senators in order to get that nomination through. Did he do that today?
I think it split right along partisan lines. The Democrats were trying to get him on, have you promised Trump anything, trying to get him on his finances, trying to get him on, and is he going to keep the Fed independence? And the Republican side completely supportive. Look, I think he's going to get confirmed once they clear up the whole investigation and Tom Tillis removes his objection. The question is, are we going to go past May 15th or not?
I think the big question, though, too, for a lot of folks is assuming that Warsh does get in there, exactly what type of Fed chair he is going to be. We played that sock puppet comment because that seems to be the fear out there. Is this going to be the inflation hawk that Warsh seemed to have sort of carved out a niche for himself over the years, or is this going to be, let me give in to what the president has been asking for, which are rate cuts and rate cuts now?
I think there's 2 things. Number one, what he's been saying is not necessarily what he's actually going to do in practice. He's talked about AI as a reason to cut rates. He's talked about we're going to shrink the balance sheet, and that's going to let me cut rates. But, you know, I don't think that either of those 2 things point to much lower interest rates. The second thing is it's not just about him. He's got to bring along the rest of the committee. And this is where I think he has a lot of work to do in terms of building up his credibility. I mean, once again today, he was pretty harsh in terms of the Fed, in terms of recent practices at the Fed. And so he's got to get people on board to support the policies he wants to pursue. So that's not going to happen instantaneously.
So what would Warsh need to do in his first, say, 6 to 12 months to build that internal credibility and get the vote of all the voting members?
Well, the first thing I think he needs to make it clear that my allegiance is with the Fed to do the right thing about monetary policy, to keep inflation, push inflation down to 2%, and keep the economy on an even keel. He's got to basically tune out all the Trump pressure. I mean, I think he's in an unfortunate position because I think the prospects of the committee wanting to cut rates in June, saying he's on board by then, is virtually nil at this point. Yeah. So President Trump's going to be disappointed. So he's got to decide where does my allegiance lie.
Not to make light of it, but did the Iran war kind of help him? I mean, if we had gone into this confirmation hearing without the war and the spike in oil prices,
it would have been a closer call. Yeah. I mean, I think then you could have had a credible argument for cutting rates a little, and he might have been able to get a rate cut up. But now he can't vote for a rate cut in June unless this whole situation gets resolved much more quickly.
So given his market experience, do you think there is a risk or maybe a benefit that he leans too much on market moves when he makes his decisions?
I think he's very knowledgeable about financial markets, but I don't think that the markets will actually drive his decision. At the end of the day, the Fed has to do what they think is appropriate, and at the end of the day, the Fed wins. The Fed sets short-term interest rates, and the market has to follow.
I am curious about just sort of this idea coming into this hearing of artificial intelligence, the potential for productivity improvements that, of course, could, at least if you believe some of Warsh's past writings and opinions, could actually maybe aid in his view of where monetary policy should go. Is it too early to even factor that in?
Well, if you look back at the Greenspan experience in the 1990s, which he alludes to, it wasn't a situation where Greenspan cut rates. Greenspan just didn't raise rates. And rates at the time were quite a bit higher than they are today. So typically when you have a technological innovation that raises the demand for capital and spurs a lot of investment, yes, that's good for inflation, but it also pushes up the demand for capital, and that pushes in the opposite direction. It pushes towards higher interest rates.
There wasn't that much talk. A few questions about the labor market, but I was kind of interested in the idea that so much of this hearing focused on the inflation side of the mandate and a little bit less on the labor side.
Well, I think because they know that if the economy is weak, then obviously the Fed can pivot to worrying about the labor side. I think the real question is, will Warsh stay the course in pushing inflation back down to 2% or not?
You've pushed back on some of his arguments for lower rates. Where do you think his framework falls short?
I think there's really two things. Number one, the AI boom in the short term is probably going to raise interest rates, not lower interest rates, because it's a huge increase in the demand for capital. And number two, on the balance sheet, he talks about shrinking the balance sheet, and that will lead to significantly lower short-term rates. I think he has the sign right. I mean, I think a smaller balance sheet does put a little downward pressure potentially on short rates, but nothing of the order of magnitude that he's talking about. It'll take the Fed probably a year to 2 years to potentially shrink the balance sheet by $1 trillion because it's going to take a lot of process work beforehand to figure out how they want to do it. And I would imagine that's going to allow you to cut interest rates trivially at the short end to offset that.
You say shrink the balance sheet. I feel like we heard this before from a previous Fed chair that came in with an intention to shrink the balance sheet, and there was a big pushback from the market on that.
Well, I think what's changed is that the Federal Reserve as a group likes the current setup where the supply of reserves is here, the demand for reserves is here, there's a small gap, and it's very easy to set monetary policy. So what they're planning to do is they're going to try to make some changes to liquidity regulation and other changes that bring down the demand for reserves. And as they bring down the demand for reserves, they can shrink the supply of reserves, and the balance sheet can shrink in tandem. But it's going to take a lot of time to work out all these details.
So in general, do you expect continuity, or do you expect a meaningful shift under a Fed Warsh? Because he really didn't give a lot of details, actually, especially when it comes to near-term rates.
No, I think you're right. I mean, I think he was pretty general, and that's probably the appropriate thing to do in a hearing. You don't want to create news. You want to avoid creating news. I think it's going to take him a little bit of time to sort of figure out where the committee is and what the appropriate was. We still have this tremendous uncertainty about the war, and how high and how long oil and natural gas prices are going to stay high around the world, and then what's the consequence of that? Should we worry more about the inflation part of it, or should we worry more about the effects on economic growth?
But where energy prices are right now, does that worry you? I mean, some would say, okay, at whatever you are, around $90 a barrel, basically still below 100, more or less, that's not necessarily the shock to the economy that it would
I think the problem is right now is that the futures market isn't reflecting the fact that we're having a growing shortage of oil. So if you look at, for example, in the UK, Brent spot prices are way above Brent futures prices. So, and over the next few weeks, the shortage is going to transition from shortage on the water to shortage on land, as the boats that people were expecting to arrive don't arrive. So, for example, in Europe, people are worried about running out of jet fuel in 6 weeks.
All right, Bill, great to have you here. Always great perspective. Former New York Fed President Bill Dudley joining us here to kick you off to the close on this Tuesday afternoon. We focus on the succession at the Fed, and we focus on the succession in corporate America. A shaking of the apple tree with the tech giant's new CEO announced. We have a slate of guests to break down the future of the company, as well as discuss broader succession trends we're seeing in the C-suite. That's coming up next here on The Close. This is Bloomberg. A big week for tech earnings. Tesla, IBM, Texas Instruments, Intel set to report later this week. Apple set to report next week, and well, let's just say front-running them all. A big announcement on a change at the CEO chair, and some big questions going forward here about the maturity of some of these companies and, well, what takes them to the next level in this new AI environment. Dan Niles joins us right now, founder and portfolio manager at Niles Investment Management. And Dan, first I do want to start off here with the changing of the guard over at Apple, long anticipated. John Turnus, not necessarily a surprise, but of course a lot of questions about Apple apparently doubling down pretty hard on the idea that they are a hardware company first.
Well, I mean, I think you need good new products, and Tim Cook was great at a lot of things. He was probably the best CEO in terms of being a politician. Didn't care if it was a Democrat in office or a Republican in office. He worked with both sides, probably the best ever at it. Also, supply chain god, that's his background. You know, really showed that during COVID and then during tariffs and, you know, what's going on right now. So can't fault him for that. What you can't fault him for is product innovation, because there really hasn't been a lot of good product innovation underneath him. I mean, if you think of Vision Pro, which was the latest product they tried to come out, they had to scrap that and are going back to the drawing board with glasses. And so I think having a hardware guy that can really focus on product vision, which you haven't really had since Steve Jobs, that's going to be great, because the growth, a lot of the performance for the stock and the growth was really in the couple of years after Steve Jobs passed away and Tim Cook took over. But he inherited a company that was growing revenues at 60% in 2011 and then grew 40% off of that the next year because you had the iPad introduced in 2010. So it'll be good to have somebody there who can really focus on products.
I am curious with regards to the innovation side, and I just want to kind of focus on some of the earnings that we're going to get this week. And there are three big companies that I think to a lot of extent, some folks have kind of thought maybe fell behind the curve, but are starting to see a bit of a resurgence. Texas Instruments, IBM, and more importantly, Intel, which is actually, believe it or not, the best performing stock over the past 3 or 4 weeks in the S&P 500. What are you seeing there, Dan, with those companies sort of reinserting themselves in the technology conversation?
Well, I mean, I think each one's a little bit different, but I wrote on Intel back on March 31st and said, look, I think this is a name that's really going to benefit from what you're seeing in the AI world. And really, if you go back in time, training was horrible for microprocessors, right? Because it's a repetitive action. GPUs do that the best. And then to some extent, inference, similarly, you're kind of doing the same thing when you're doing a chatbot-based interface. When you go to agentic, where you might be, let's say, Romain, you're building out a spreadsheet and you're saying, hey, go to the SEC, get me some data there, go to Bloomberg, pull down the latest things around Intel, then go ahead and build me a spreadsheet. When you go to that world, microprocessors serve as the orchestration for that in terms of organizing all of that. And so the importance goes way, way up. So some of this is as the AI era evolves, different companies are taking the baton, and whether it's Intel or AMD or ARM, which you saw had an analyst day, they're getting into making chips as well. Cerebras filed for an IPO. All of these companies realize how much more important microprocessors are, and the good news is AMD and Intel are both already doing that.
And you've compared today's AI build-out to the late 90s internet boom. What are the strongest parallels you're seeing?
Well, I think it gets back to Claudebot. And so, as I said earlier, the first couple of years were training. Last year, it was about chatbot-based AI, right? You ask a question, it gives you an answer. This year, it's about agents. And what you've seen with token generation is before Claudebot came out on January 30th and was formalized, your token growth was about 20% over the prior 2 months. after Claude came out, your token production was up 100% over the next 2 months. And so you're seeing corporations really starting to adopt this. So I think we've got at least a year of strong build out because you're starting to see monetization of that as well. You've seen the numbers for Anthropic get revised higher very quickly as an example of that, which is sort of the leader in the space. But you're hearing some positives coming out of OpenAI as well. And so I think you've got at least another year of strong growth for the AI infrastructure build out because of agentic AI kicking off at the end of January, spurred on by Claude.
Just over 30 seconds here, Dan. The rally has been incredibly fast. We're seeing a lot of momentum reverse and flip quickly. Does this worry you? And what do you think will make it flip back?
Sure. I mean, on Sunday, I wrote about this and said, look, this is the fastest you've gone from oversold to overbought in the S&P 500 since 1982. So this is a massive rally. But oil before Iran was in the low 60s. It's now in the 90s. And so you're discounting a whole lot of good news. And so I think earnings season, you got to be careful about that because you've seen what ASML, TSMC, which are at the heart of the AI trade, they got hit after earnings, and Netflix obviously deserved to get hit, but they're a tech company too. So the expectations are sky high, and you just want to be careful.
Dan, always a pleasure. Always great. Dan Niles, founder, portfolio manager at Niles Investment Management. A closer look at the tech space, and when we come back, we get even closer, deeper into Apple, deeper into that succession shift, and deeper into its upcoming earnings report next week. That's coming up next in our top calls with Barton Crockett over at Rosenblatt. Stick with us. This is Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. Let's start off with Ball. Raymond James upgrading the aluminum can and bottle maker to outperform. The analyst citing limited Mideast exposure and a beverage can business with, quote, structural tailwinds behind it. Those shares, which are slightly down on the day, still off to one of their best starts to a year, up more than 20%. Next up, Intel, HSBC upgrading to buy and almost doubling the price target to a street high $95 ahead of the chip maker's earnings this Thursday. HSBC says Intel's server CPU business is the main near-term catalyst that will help drive up earnings. Intel shares the best performing stock month to date in the S&P 500. Finally, CrowdStrike, KeyBank raising its recommendation on the cybersecurity company to overweight. The analyst calling Anthropic's Mythos AI model the catalyst to AI-driven cybersecurity demand that they've been looking for. Those shares now on a 5-day, 14% run, and those are some of our top calls. We down and want to turn to Apple. Those shares lower on the day after announcing that Tim Cook's 15-year run at the helm is set to come to a close in September, handing over the reins to hardware specialist John Ternus. A spectacular run for Tim Cook, though, a more than 2,000% gain on a total return basis for the stock, $3.6 trillion in market value added, and a 699% boost in profits from September 2010 to 2025. Barton Crockett joins us right now, senior research analyst over at Rosenblatt Securities. And I do want to start off with that profit picture. This has been a cash juggernaut, a profit juggernaut, even though sales growth may be moderated in recent years. We are going to get an earnings report next week, Barton. And I am curious as to what you think the company might articulate about the longer term growth that we can see in some of these numbers.
Well, look, I mean, I think that they'll harken back to this being their 50th anniversary, basically, coming up here this summer. And obviously there'll be, an opportunity for Tim Cook to talk about what's happened in his tenure. And then we'll start the process of kind of moving to the next generation. John Ternus is coming in on a real high point. I mean, their iPhone growth has really blown everyone away. They're, driving kind of mid-20s kind of percent kind of growth in iPhone, powering the entire company to kind of mid-teens plus kind of total revenue growth. And I think that there'll be some reason to kind of question the durability of that. I expect them to express confidence. I mean, Apple, in a troubled time for the smartphone industry, is taking massive share. The one kind of thing I think to worry about in terms of the earnings story near term, though, is spending. With this surge in, the iPhone and this very healthy revenue growth, they're spending a lot more on R&D, up over kind of 30% year over year is where we're trending. And that's really put a capper on EPS growth, which is really, growing kind of in tandem with revenues, but no margin expansion. in this scenario. So, the question is, does that continue? Can they get some margin expansion over time? Or, is this just the cost of the game in this new world order of supply chain issues and AI kind of development?
So choosing Turnus isn't really a big surprise to many of the people that we've spoken with. But why now, considering that the company and the industry at large is really facing these revolutionary crossroads? Is it a bit too early, you think? Because September is a few months out.
Yeah, look, I think that they could have done this announcement really before earnings, after earnings, a year later. I think they're doing it now, partly because they feel comfortable where the business is. The iPhone is doing tremendously well right now, and a lot of the credit for the 17 success, lies, with Turnus and his organization and his leadership. They've moved into a new form factor with the MacBook, with the Neo, which seems to be a real success. So I think it's an opportunity for Tim Cook to leave on a high note and for John to come in on a high note. The fact that they're doing this before earnings says that they must be very comfortable with the quarter, I think they were circling the airport to do this and said, okay, let's land it now because it looks good.
Yeah, it looks good. And I'm glad you brought up the Neo. Is that sort of indicative of maybe what we can expect out of Turnus in your view, this idea of, I guess, maybe broadening, not just the lineup, but broadening the customer base by introducing some of these lower cost products?
Well, look, I think that, in the scale of more kind of nuts and bolts, which Apple has been excelling at and Turnus has been excelling at, it makes a ton of sense. I mean, to go after the Chromebook market, with an Apple flavored product when the Chromebook makers are really pressed by supply chain and Apple can leverage its advantages there. That's really a great move, and they're doing it, it would seem very successful. We'll hear more on the earnings call. So those types of shoring up the peripheral of your core is great. But what I think makes Apple really exciting is, and what keeps us at neutral, because we don't see this today, but we wonder because we might see it in the future, is what is this next revolutionary product? And that's when the shares can really work. Could that be AR glasses? Could that be some AI device? Could that be, humanoid robots? Something that could really, bring the magic back at scale that matters for Apple is, I think, what you'd love to see and maybe invest ahead of. And we might see that at some point with Turnus in charge.
All right, Barton, got to leave it there. Barton Crockett over at Rosenblatt. And just a reminder, Apple's set to report earnings next Thursday, April 30th. When we come back, we stay on this story and take a closer look at CEO succession overall with Wayne Peacock, the former president and CEO of USAA.
I'm a big fan of Tim over the years. He's made me and my clients a tremendous amount of wealth, and he's mostly done an excellent job. But, I've been calling for him to step down. It's been time for new blood at Apple. It's been time for change with AI and so much innovation in software that really Apple has fallen behind on despite their hardware being so excellent.
Yeah.
This is a great move for Apple.
That was Ross Gerber reacting in real time yesterday on The Close to the announcement that Tim Cook would step down as CEO in September, 3:30 p.m. here in New York. You are watching the countdown to The Close. I'm Romaine Bostic.
And I'm Isabel Lee.
And Isabel, I don't know if you were following this as it sort of broke last night, but there was all this talk, this idea that Apple had kind of become a laggard. You talk about this outperformance that we've seen with the stock since Tim Cook took over back in 2011, but when you sort of narrow it down to the past couple of years, they've kind of lagged behind because of concerns about innovation.
There is definitely that. I mean, they've been behind on the AI shift, so to speak, and many are saying that this new boss that they've tapped is like a Tim Cook Jr. And I'm wondering, is that a good thing that he's a Tim Cook Jr., or is it a great thing? So it really depends, and analysts are probably digesting it, but a stock is down, Romaine.
Yeah, and that's going to be the big question for investors, though they have a few months, I guess, to sort of parse it. Let's get some insights right now out of someone who knows a lot about what goes on in this space. He actually does sit on the board of the National Association of Corporate Directors, and he was the former president and CEO of USAA. Wayne Peacock joins us right now. Wayne, great to have you here on the program. I was kind of going through, I was looking at kind of the average tenure of CEOs, at least for the, Fortune, the S&P 500 companies, and it's like 7 years. So to go 15 years in a job like that and to be successful, relatively successful for 15 years in a job like that is certainly no small feat. but it's a pretty small universe of CEOs now that are at that level here, particularly for companies that are kind of still tethered to their founders, like Meta, like Tesla, NVIDIA, et cetera. I want to get your perspective here as to when the board really starts to have these hard conversations about when these people should actually be replaced, even if they are still performing relatively well.
Well, Romaine, I think, first of all, you're correct. There's fewer and fewer of these CEOs who have been around for a long period of time. Tim certainly had a tremendous run at Apple, but we're seeing shorter and shorter tenures. I think that's because of the continued pressure from shareholders and stakeholders, the change in technology, AI transformations that are underway. They're all combining to kind of drive shorter terms out there. But as to your very specific question, I think the CEO transition really starts the day that you hire a CEO and begin to plan for the next one. And I think when there are transitions going on in the business, no matter how good your team is today, the question has to always be, is it the team that you need for the future? And that may be part of what is at play, here with Apple's most recent announcement.
I know it's way, way too early to judge the success of this CEO transition because it really hasn't started. But I am curious about the process, particularly in light of some recent, let's just call them flops, if you will, whether it was the Disney transition, Starbucks, Walgreens, a few others. This was somewhat well telegraphed. It does seem to be that Ternus was kind of high on the list, that at least from what we knew publicly. And given that he was basically a disciple of Tim Cook and had been with the company for some time, do you get the sense that this could be a relatively smooth transition?
Well, I think from process so far, these guys get a grade of A. There is no doubt that they've been working on this for a long period of time, both preparing the internal candidates, talking with Tim about his future and his timing, bringing the board along as to what is needed in the future, and then making a decision with a lot of specificity. Tim announcing that he's leaving on a certain date, John coming in on day one, John coming in to join the board, and Tim staying on as the executive chairman to drive continuity. So I think early days from process, extremely positive. The question will be, how well do they complete the process over this next 12 months as John gets in seat? And then how well does he actually perform and address the challenges that are resident in the market in front of them?
In multiple Bloomberg stories, Ternus is often called Tim Jr. Is that more of a positive or a negative for you?
Well, I think the jury is out on that. Look, Apple is a company that has done a tremendous job over the years of building internally, driving continuity from an internal perspective, and recognizing that those who understand all the mechanisms across the company are going to do well. So I think bringing someone in who understands how Apple operates, makes a tremendous amount of sense. Now, whether he is the right person for the future, I think the jury is still out on that.
And Apple's been pretty measured when it comes to AI. So does this feel like a moment where they can finally lean in more aggressively? I mean, Ternus is known as a hardware guy.
Well, he's known as a hardware guy. He's been involved in software. He's, I think, spent some time, on the AI front. But maybe this is also one of those questions that Romaine asked, where the change for AI is in front of us. It's time for innovation and change at a faster pace, and probably a good time for someone of Tim's age and tenure to step down and let the new generation of leaders at Apple take over. Again, I think the jury's out, on how well he will respond. But this first 12 months will be critical to see how decisive he will be, how bold he will be in making necessary changes for Apple's future.
I am curious, too, particularly about your involvement with that Blue Ribbon Commission that we talked about with regards to, taking a look at sort of how boards are run, the CEO role itself here, and the interplay between the CEO and the board. I mean, we've seen unhealthy relationships where the CEO comes to dominate the board, and we've seen much more symbiotic relationships where they work kind of, I guess, as intended, at least based on what traditional corporate governance structures are supposed to look like, Wayne. What do you see kind of across the board, not necessarily just with Apple?
Well, Romaine, what we really studied and dug into in this past year was the role of the lead independent director or the chair, both in terms of her or his relationship with the CEO and relationship with the board more broadly, kind of the linchpin of ensuring that the culture across the board and senior management, especially with the CEO, works really, really well. And I think that will be critical here as you have a CEO stepping into that role, that they find the right boundaries for the role Tim will play, the role that John will play, so that there's shared accountability, but very specific roles playing forward. And what we found in our research is when that relationship is healthy between the board chair or lead and the CEO, everything tends to work better both in the boardroom and with stakeholders, including the employees more broadly.
Wayne, real treat here. Wayne Peacock, former president and CEO over at USAA, as you continue to focus in here on the big transition at one of the biggest companies in the world. When we come back, we're going to turn to the defense sector here, particularly in the U.S. In the face of some earnings coming down the pike out of names like RTX, Lockheed, Northrop, and some others, high expectations, particularly in light of the war in Iran. It's our stock of the hour, and we're going to speak to an analyst who covers those names best. That's coming up next here on The Close, right here on Bloomberg.
RTX shares down by 4.5%. The company reporting earnings this morning, raising the profit and sales outlook due to increased missile demand. Joining us now is Tony Bancroft, research analyst at Gabelli. Thank you so much for joining us here on set. So what defines the next cycle in defense for you, hardware or software, and who wins?
Yeah, that's a great question. I think the big picture, Isabel, I think, obviously the war in Iran is going on right now, but I really think that's sort of in the long term, that's sort of a foregone conclusion. I think the reality is sort of the next big thing, which is still the pivot to the Pacific. We've underspent for nearly 2+ decades with the peace dividend over the Cold War. And I think, if anything, the war in Iran illustrates the amount of missiles that we're going to need to operate in the Pacific theater, and just the change of weapon systems. The ranges are much larger, and and the warfare has changed, and so you're going to see a lot of defense spending, likely at 1.5 trillion defense bill. A lot of that's going to be in missile production, autonomy, space. And I think that's the next cycle, and it's a pretty big cycle. I
am curious with regards to some of that spending, and just you used the word change with regards to how warfare has changed. There's been a lot of talk here that maybe sort of the next big wave of new devices, if you will, aren't necessarily going to be the gigantic missiles. They might be smaller drones, things that are a little bit more nimble, things, quite frankly, that aren't necessarily made by the Boeings and Lockheeds and RTXs of the world.
Sure, I think there will be the neoprimes, they like to call them. I think there's definitely a place there. I think the pie overall is getting bigger, right? 1 trillion to even a fraction of the 1.5 trillion is a number that's order of magnitude larger than the most bullish analysts in the street for what the U.S. defense budget was going to be. So I think defense primes are going to get their share. They're going to be a big part of the Golden Dome. But the reality is a lot of the Golden Dome is still going to be built by the defense primes. A lot of those missiles, the kinetics, if you're going to stop something going Mach 5, you got to sort of go Mach 5 too. And there's not a lot of people that can do that. And there's going to be a lot of autonomous systems and a lot of growth there. But that's a little more. There's some commoditization there, where the exquisite weapon systems that the French primes do, it's just hard to do. It's physically, the physics of it is just hard. So I think everyone's going to get his or her share.
So how sustainable is this surge in defense spending? And talk to us about the distribution of demand. In what regions do you see more of it and less of it?
For sure. I mean, I think, listen, the U.S. is going to be a big part of it. I mean, if you were to do everything on a post-World War II, Cold War timeline basis, federal budget, percent of GDP, we're still well below those numbers. Those were 25% of the federal budget, 6 to 7% of GDP. We're at 15% of federal budget, 3 to 4% of GDP right now. So we're still really under what our structural defense spend was for all those 40+ years after the finale of World War II. I think Europe is also going to see a big improvement. They already have, from going from less than 2% target to the 2% target, and now the 3.5% target on actual procurement. That number is $400 billion, just the 3.5% for NATO ex-US, and that number is that's going to continue, and it's probably going to have to grow higher than that to catch up and sort of see what we've seen in Ukraine the last few years, and now what we've seen in Iran.
I'm curious. With regards to the share reaction that we're seeing, particularly today with Northrop reporting, RTX reporting the shares down, despite the fact that they beat and I think they both raised guidance.
GE, I think, kept it going. But yes.
But why don't you think we saw a more positive reaction in the shares?
Yeah, I think there's the bogey out there. The war is still ongoing. The threat of shortages in jet fuel, which we've all seen, especially particularly in Europe. Yes, and just travel, of course, as well. I know the Mideast is about 5 to 10% of commercial travel globally, but it's meaningful. Everything's on the margin, and that lag effect of any kind of delay and the uncertainty, I think they take it out on the two largest commercial engine operators in the world, and the aftermarket for that and the services of that will get affected by less flight hours.
Tony, great stuff. Got to get you back. Tony Bancroft, research analyst over at Gabelli. And just an update here on the situation in Iran. The Associated Press now reporting what a lot of people have been speculating, that Iran will not be attending those talks in Islamabad on Wednesday. They have informed the U.S. via Pakistan that it won't attend those talks. That's according to the Associated Press, citing a U.S. official familiar with the situation. Stocks now hitting session lows. Big moves in treasuries as well. A full recap of what's happening today when we come back after the break.
I think he's in an unfortunate position, because I think the prospects of the committee wanting to cut rates in June, saying he's on board by then, is virtually nil at this point. Yeah. So President Trump's going to be disappointed. So he's got to decide where does my allegiance lie.
Former New York Fed President Bill Dudley kicking us off to the close, a focus on the nomination hearing earlier today in the Senate for Kevin Warsh to be Fed chair. One thing that the markets have kept their eyes on today, but we're now seeing stocks hit session lows on the back of a headline right now, Isabel, that those talks that were set to take place in Islamabad between U.S. negotiators and Iran, that's been called off.
It's really interesting because it seems like a short-term market. On one hand, it's so headline-driven. On the other, you see this immense rally. If you zoom out a little bit, if you go by maybe just even a couple of weeks, and you see since March 30, tech, for instance, has really come from the worst sector to the best sector. So it's really, I think, what's looking like a fragile market.
Yeah, and it's going to be put to the test here potentially over the next 24 hours or so as we wait to find out what the reaction will be by President Donald Trump. Joining us here in Studio 2 in New York is David Bianco, America's CIO over at DWS Group. And David, I do want to start with this phenomenal rally that we just had. I mean, just breathtaking by so many measures here. But now a lot of questions as to whether we hold these levels, given the idea that maybe this sort of path to a ceasefire, to a prolonged ceasefire, is not quite as smooth.
Obviously, it's a confusing, uncertain, fluid situation. Hopefully they can keep Air Force 2 fueled and ready to go in case the negotiations are back on. But this is a situation where nobody knows what's going to happen. Investors should remain humble about the uncertainty. We know that we've been given some encouraging messages from the president and leadership, but this is a wartime situation. Some deliberate disinformation or just plausible positive scenarios are all part of the game and the strategy. So look, even though a lot of good news happened last week, some of it could be fleeting. I don't think the S&P goes back to its full lows, but I don't think it belongs over 7,000 either. Now, one of the reasons why the equity market ignored much of the conflict, even then, the pullback, even at its lows, wasn't so bad, was we've seen strong upward revisions at the S&P 500's earnings for 2026. But that's really a story of just a handful of semiconductor companies and the energy sector, but mostly semiconductors.
Well, that's what I'm curious. I'm glad you went there on earnings. And I know we're still very early in the earnings season, but overall, I mean, it's been decent, certainly with regards to the past 3 months. The guidance has been a little bit more mixed here. Right. But this has sort of been the argument that a lot of the bulls will make, that basically until we actually see the Iran war show up on the bottom lines of these income statements, there's no reason to be bearish.
Well, I don't agree with that. When it hits the bottom lines, the market will have already been in a full-blown correction. But look, I agree with the idea. I mean, a couple of weeks ago, I was arguing to stay calm about these risks. Now I'm saying don't ignore them. And my view is that it's going to last for a while longer. Even if there's a ceasefire that lasts longer, okay, we'll do the trip in days to come. The strait's still effectively closed, and we're running with more and more tension on supply. But the point is, earnings have been good. Yes, you're right, guidance has been mixed, but the only reason why the earnings are so strong is because of all the capex on the data centers, and that may be close to immune from this conflict. Not fully immune, there's some scenario, but close to immune. But in my mind, it's still best to stay away from the sectors that are at risk here. Consumer sectors, small cap sectors, things that are sensitive to higher interest rates and higher oil prices in general. If that's a risk to your outlook, respect that risk.
So you brought that up. Oil prices and bond yields, they remain to be elevated. How much of a risk do you think they would be to equities?
I'm more concerned about bond yields than I am oil prices. That's because of the way the S&P 500 is made up and because the PEs are so high. And if the 10-year Treasury yield stays well above 4.25%, not much above it right now, but it had gotten there during some of the biggest concerns about oil, how high oil could go. That weighs on the PE, and it can really put a lasting wet blanket on some of the areas where investors are hoping for recovery this spring or this year, like housing and consumer spending. Those two things, I think, are going to be sluggish in spring.
So then do you think the growth story is overpriced across assets?
No, well, the earnings growth is real. You're going to get 15% earnings growth in this quarter and pretty much this year for S&P earnings. Just recognize where it's coming from. Technology, tech hardware, actually not so bad at software either. Those earnings estimates have held up, so all of tech and most of communications, I think, is a place to be. Financials are still doing very well, but that's a sector that if we get a broken consumer, some credit costs would come, but nothing terrible. Financials, domestics, and where the valuations have some upside, and healthcare and utilities are two sectors that I think are least exposed to these risks, fairly valued with good growth potential as well.
I do want to go back to your comment about the Treasury space here and what we're seeing in yields, and at least for right now, seeing that elevation 4.3 on a 10-year yield, and pretty much has been a lot of selling that we've seen on the longer end of the curve, though today much more on the shorter end of the curve here. When does that become a more material risk economically? And I don't mean that just in terms of people putting their models into their cash flow statements, but we talk about all the drama that's been going on in the private capital space and the idea that maybe the savior was going to be lower interest rates. And we had Warsh on the Hill today ostensibly talking about the potential to maybe even cut rates this year.
Right. So it's not just about the DCF calculations, which do matter when you have PEs as high as they are. However, these high longer-term yields, I don't think so much short-term interest rates, but 10-year Treasury yields and mortgage rates have been restricting certain parts of the economy, like housing. That could last longer if the 10-year yield doesn't work its way down. Now, we know we have Warsh and talking about cuts and doing it in a certain way. My view would be take your time with that. We know that Warsh is not a fan of a large balance sheet. If he doesn't want to see an expanding balance sheet on his watch, then maybe be slow in those cuts. That way, when the economy needs cuts, plenty of cuts can be delivered. But right this moment, I'd hold horses.
Well, also, I'm curious, too, also about kind of the relative strengthening that we've seen in the dollar. I know on a historical basis, still relatively weak, but sort of correlated with everything that's been going on in Iran and all of the big movements cross-asset-wise. We've seen that dollar creep up, and I do wonder if that becomes a problem as well.
Well, a stronger dollar, and it's gotten slightly weaker versus euro. The euro's had a little bit of improvement the past week. But a stronger dollar is not good for S&P profits because of foreign operations. But the S&P is drawing so much of its earnings growth from things that are just independent from that, like tech and financials. So I would say to you, a stronger dollar when oil prices might go up higher, that's just something that talks to U.S. strength, U.S. resilience, and the U.S. being the best bloc in the neighborhood during this conflict.
All right, David, always great insights. David Bianco is America's CIO over at DWS Group, counting us down to the close with just about 2 minutes until we get there. A market that actually opened higher on the day, but is now dipping not far from session lows here on the latest headlines that the talks that were set to take place between U.S. and Iranian negotiators for now called off. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Isabel Lee, Katie Greifeld out on the day. We're taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. a slew of catalysts battling this market around today. Carol Massar, take your pick here. But for right now, we're red pretty much across the screen.
Yeah, we are. Definitely more of a risk-off trade. It was a little bit more evenly spaced earlier in the session. But yeah, we know what's going on. The market's so reactionary to any news on putting an end to the U.S. war with Iran and keeping hoping that there's going to be these peace talks. But again, we just got moments ago, and you saw markets, the equity markets go down. You saw treasuries go down. You saw yields shoot up a few basis points.
And you saw oil, at least Brent, the international benchmark, hit $100 a barrel for the first time going back to April 13th. I was just saying to Carol that there's not a lot of time between right now and the end of what is supposed to be a ceasefire tomorrow. The president has also said that that will not be extended, so it's sort of unclear what happens in the next 24 to 30 hours when it comes to this conflict.
Take your pick, and I was going to pick oil, but Tim stole it for me. Yes, it's above $100 a barrel. We have Commerzbank earlier today saying that it will be above $80 a barrel by the end of this year, but I think that's not even considering all of the developments we're seeing. So oil, I think, is one of the important stories that we should be watching.
Absolutely. Here, and just a reminder, we are expected to get some earnings after the bell. Probably the most consequential for markets is going to be from United Airlines. We're also going to get Interactive Brokers, Intuitive Surgical, EQT, and Capital One. Right across the screen here in the United States of America, with the Dow Jones Industrial Average down almost 300 points, or about 0.6%. The S&P losing a similar percentage on the day. The NASDAQ Composite down about 0.6% as well. And the Russell 2000 lower by about 28 points, or about 1% even. All
right, back to the S&P 500 I go. And as I said, more of a risk-off trade. You've got 337 names to the downside. Isabel, 166 to the upside.
If you look at the IMOP, we're seeing it's loading for me, but there it is on the screen, completely red on the screen, except one tiny sliver of green there, but everything else is really looking like a down day today. The biggest losers, communication services, communication discretionary, and industrials.
United Airlines out with their earnings right now. Here, adjusted EPS looks like a beat, $1.19. The street was looking for $1.09. Operating revenue, $14.6 billion, slightly higher than what the street was looking for on average, of roughly about $14.5 billion. We should point out that available seat miles looks actually a little bit light, 77.7. The street was looking for 77.9, and passenger miles at about 63.39. The street was looking for about 62.66. The company also saying that it does plan to cut 5 points of capacity for the rest of the year. Sees capacity in Q3 and Q4, Carol, to be flat to up by about 2% year over year.
All right. And right now, we see the stock down about 1.8%. I'm going to let Tim take it.
Yeah, I'm looking right now just at what's happening with United, down 1.8%. I'm looking at the press release. The company saying oil prices remain volatile and elevated versus the start of the year. United has already begun adjusting its schedule for the rest of 2026 to account for higher fuel prices, with an expected, as Romain mentioned, 5-point capacity reduction versus the original plan. As a result, the company expects capacity in the third and fourth quarters to be flat, to up approximately 2% year over year.
We got to get to that redhead, Tim, that's crossing the wire right now. Full year adjusted EPS. Here's your guidance. The company says expects $7 to $11 a share. It had previously had a range of 12 to 14, so a material drop in its EPS guidance. The street was looking for 9.08 here, so the low end of that range of 7 comes in below that. The company also said that its fuel expense in the quarter that just passed, that was $340 million, $340 million, Isabel, year over year.
Another thing I'm looking at, which Bloomberg reported earlier today, is how Trump is opposing a merger between American Airlines and United Airlines, saying he doesn't like having them merge. I feel like this is also a story we need to be looking out for, which is the acquisition or the merger of all of these airlines, whether it will even pass the regulators, Romain.
Yeah, certainly something. There's a lot going on in the airline industry. United Airlines, just going back there, down still about 1.8% here in the aftermarket. Company also commenting on fiscal year adjusted CapEx below $8 billion, below $8 billion. The estimate on the street is $7.71 billion. But again, it's that outlook. Fiscal year adjusted EPS, $7 to $11, had seen 12 to 14. Street estimate was 908. So street seemed to have gotten a good, kind of good read on it.
Well, it shouldn't have come at too big of a surprise. I think Delta decided not to update its full year outlook. It cited uncertainty tied to fuel costs, geopolitical tensions. Look what happened this morning with Alaska Airlines Group. They pulled guidance for 2026 altogether. So, United coming out and saying, okay, it's not going to be what we thought it will be, but at least we're giving you numbers here.
Yeah, and it's kind of interesting, too. We're going to have to wait until tomorrow for their earnings call here to get a little bit more color out of the executives as to exactly sort of what they are looking ahead to here. I think we kind of have already managed to sort of look a little bit ahead, around the corner, if you will, given the prolonged nature of what's happening in Iran, the impact on fuel prices. And I think what a lot of people, Carol and Tim, are very sort of concerned about right now, the idea of how that feeds through into consumer spending and whether it tamps it down. We had a retail sales report this morning that showed, at least for the month of March, there wasn't a material impact just yet.
Yeah, exactly. It's an interesting point. I'm just looking at some of the other airlines. I pulled up American Airlines in the after hours. Not really much of a movement there. We are seeing JetBlue under some pressure in the aftermarket, down about 2%. So just trying to see if there's any carryover, because we continue to see United down about 1.8% here, guys.
Some other headlines that we're getting: United seeks to take delivery of over 250 aircraft by April of 2028. The company, though, cutting that fiscal year adjusted earnings per share forecast. First quarter fuel expense increases $340 million year over year. Fiscal year adjusted earnings per share comes to $7 to $11, saw between $12 and $14. The estimate was for $9.08. Still shares down about 1.8%.
I'm looking at our full story here at Bloomberg Terminal, and the guidance, as we know, came in stronger than expected, but it said demands remain strong, particularly among higher-paying customers, echoing comments from Delta and Alaska. Again, this is the K-shaped economy that everyone is talking about. If you're lower income, you're struggling, but if you're in the higher income realm, life is pretty good.
Well, let's talk a little bit more about that economy. Credit card company Capital One reporting earnings right now for the most recent quarter. Adjusted EPS did rise to about 4.42 a share versus what it was a year ago at 4.06. Revenue was actually up 52%. Of course, some of that aided by some of the structural changes in the company here. But the company's net interest margin did miss estimates, 7.87%. The street on average was looking for about 8.2% here. And the provision for credit losses was higher than expected, $4.07 billion. The street was looking for about $3.81 billion, Tim. And you see the shares slightly lower by about 2%.
It's that last headline, Romaine, that got my attention. Mm-hmm. The first quarter provision for credit losses coming in above estimates. Romaine, I mean, is the message that they're sending we're sort of planning for a consumer that could be a little weaker than we thought?
Well, yeah, and it goes back to that retail sales report, too. It was strong overall. There was a lot of spending on items, but, of course, one of the key metrics in there was how much people actually spent on gasoline in the most recent quarter. And eventually that gets to the idea here of sort of, if you're spending more on an essential like that, of course, it means the discretionary items, whether it's travel on a United Airlines or buying clothes and other things, maybe that gets stripped.
Yeah, right. You have to make choices. It squeezes out other buying, and then, you start to see certainly an impact, ultimately expected to play out in terms of economic growth. I mean, this is the thing that we keep talking about here, Isabel, is that the longer this situation goes on, uncertainty goes on, higher costs, higher energy costs that really affect so many different Americans. I mean, eventually, the longer it goes on, it's going to potentially play out in retail spending and overall economic growth.
And the longer it goes on, we're going to see a deeper global energy crunch. I mean, the flows through the vital Strait of Hormuz is essentially at a standstill right now, and that's just one of the unresolved issues. I mean, we also have Islamic Republic's nuclear capabilities and Israel's military operation in Lebanon, and the list goes on.
So I guess the question that I have, then I'll go back to this, is as we parse earnings, Romaine, is the real backdrop of what the market is grappling with. It's certainly, yes, it has to do with the micro and what these companies are saying, but it also has to do with what's happening in the Middle East. How long energy prices are going to be elevated, to what extent that affects the consumer, to what extent that is the flow through. I mean, we had Sam Dart from Goldman Sachs on earlier saying that she thinks manufacturing is going to be the next shoe to drop when it comes to the flow through on energy because of the chemical price price increases that we're going to see.
And it's kind of an elongated nature. We always talk about kind of the lagged effects of, say, like monetary policy, but a lot of the strategists we've talked to also talk about the lagged effects of this elevation that we've seen in energy and commodity prices, and is not going to show up in those first quarter numbers. But when you get to the Q2 earnings season and Q3 and beyond, maybe you start to see a more material impact on the bottom line.
All right, just to remind everybody, you've got United Airlines stock down about 1.2% in the aftermarket. Capital One also out with results, and they're down about 4.5% here in the after trade. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Romain and Isabel continuing there on The Close on Bloomberg Television. Tim and I back here on Bloomberg Business Week Daily on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. When we come back, we're going to dive deeper into those results from United Airlines. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Back-to-back losses for the S&P 500, and that is on the back, of back-to-back gains in crude oil prices, up about 3% here on the date on NYMEX crude, largely because of concerns here about the breakdown in the peace process with regards to the war in Iran. Headlines crossing the Bloomberg terminal just a few minutes ago saying that officially that J.D. Vance, the Vice President of the United States, has called off his trip to go to Pakistan for those talks. This after the Associated Press have reported that Iran had basically said it wasn't going to show up at all. Now, it's not all doom and gloom out there. The Dow Jones Industrial Average up for the 13th time in the last 15 days, though we should point out this is largely because of a massive short squeeze going on with Avis Budget Group, CAR. Those shares have been on fire, up 17% today. In fact, up about 400% just over the last 3 weeks alone. Another bright spot is on semiconductor here. Some bright spots there when it comes to the outlook for the chip space. So investors do have something to hold their hat on. Apple not really getting much love here. A bit of a knee-jerk reaction to the downside on the succession plan with Tim Cook stepping down and John Turner stepping up. I do want to turn your attention, though, to D.R. Horton. The big home builder reported earnings. They reported guidance, raised that guidance in a big way, and you saw a huge pop in their shares. Meanwhile, you had 3M, which also reported solid earnings for the quarter and raised their guidance as well. But you see the share reaction there. That was actually to the downside. And that actually brings us to our top story to kick off this hour, a focus on the earnings season and the bar set by analysts and what actually constitutes good enough for investors, particularly in an environment mired in uncertainty stirred up by the war in Iran. According to Bloomberg Intelligence data, the 53 S&P companies that reported beats on EPS so far this season, collectively, they've actually seen their shares fall, not rise. It's a testament to how geopolitics has subsumed earnings results and made forward guidance that much more important.
What's the next positive surprise versus negative surprise? And, we're done with that whole geopolitical thing, it seems, but are we? I think that's the question. And then on top of that, we're starting to see the potential impact of higher oil prices in consumer companies' forward guidance. So I think the risk is the impact of oil shocks takes a while to play through.
And we do just want to bring to our attention, to our viewers here, just how fast moving these headlines are. We're now hearing from the President of the United States, who says that deadline for the ceasefire, which was, in his words, late Wednesday, that now will be extended until talks conclude. These are the words of the president. We have to parse exactly what that means. But for right now, in a post on Truth Social, he is effectively saying that ceasefire deadline will be extended, I guess, as a chance to get those talks underway. We do want to go back to the earnings, though, that we just got out of United Airlines here, which slashed its full-year profit outlook, largely because of concerns about the rise in fuel prices because of the war in Iran. Barbara Doran joins us right now. She's the founder and CEO at BD8 Capital Partners. And he joins us now to discuss. Barbara, it's hard to keep up with what's going on in the world here. I mean, just a few minutes ago, we were talking about the peace talks were off. The president now at least providing some sort of a reprieve here for markets. But there's a lot of damage here that these CEOs are having to parse. And we heard from United Airlines, at least based in their written earnings statement here. And we've seen the impact, higher fuel prices, and that's going to weigh on earnings for the next few months.
It will, and that's the uncertainty and why we are following so closely, because it is all about oil prices and what it does to jet fuel. You had Delta report a couple weeks ago, and surprisingly, even though they reduced their numbers, they still had very strong demand, and that's really the key here. Is it going to affect consumer demand? And so far, it's not. I mean, you mentioned earlier the March retail numbers were actually better than expected. Jobless claims are still holding up, and when you look at some of the credit card data, American Express is still seeing double-digit growth in travel. People still want to travel. There's been business surveys showing corporate spending and travel plans are still intact. In fact, it's expected to be up 6% year over year. However, Bank of America, they look monthly at all they have some 64 million accounts. At the end of March, they started to see a slight decrease in travel-related spending. So we've got to watch that carefully. And I think, obviously, we're watching everything that happens, because if it's going to be short-lived and it does impact earnings in the second quarter, people will look through that because they know it's a one-time thing. It's really, as it extends, the uncertainty increases and the impact. And it's really, will it hurt consumer demand?
Yeah. How much can travel sort of be the barometer for where we are in this economy, whether it's flying, driving, whatever? I mean, we'd be remiss in not pointing out it's late April. I mean, if you have a family, you're probably already starting to look at summer vacation plans, if at all.
Right.
Should that be something investors should pay attention to?
Roman, you should, but I think, because summer bookings are coming up and people do love to travel. We know from anecdotal and even, all the evidence the last few years, people are swarming in Europe, Americans. But there has been, I think, since COVID and the lockdown, people are still, and younger people want the experiences, not so much material goods. So I think there's also been a bit of a secular shift, but we are heading into a seasonally strong time, so that if the war issues are resolved in the next month or so, I think the airlines can recover here, despite, they will take a knock in second quarter, but it should be okay.
Well, let's talk about the airlines and some of the levers they have to pull. I mean, we heard from Ed Bastian, I think, last week, who talked a lot about the pricing power that at least he sees in his airlines. Even United today, I mean, while they did have to sort of lower their guidance, they said they were going to reduce capacity. And as someone who's been basically flying almost every weekend for the last couple of months, I could tell you, I haven't been on a plane that wasn't 100% full.
Yeah. No, I think that's true. And it's interesting because you saw Delta do that. They're all reducing capacity because obviously there's going to be margin impact here, with fuel prices high. And you're also, they're raising bag fees, which nobody likes, but they're raising that dramatically. And so far it's not impacting demand, but that's where we're going to hear more tomorrow. They're not doing their earnings call tomorrow, as we know. And that's where we're going to get a little bit more color. Because if you remember last year, with the tariff uncertainty, United did a very unusual thing. They gave two forecasts. One, if you remember that for the earnings, right? If tariffs stay as they are, it would be draconian, but if it eases up, so they didn't do this time, and they actually did reduce their earnings, which for the year, which is interesting, because Delta did not. Delta did not update it, and Alaska suspended it. So they must feel they have some visibility, but they did cut it, and I think that's a recognition of the hit they're going to take in the second quarter.
You brought up American Express. I think they reported on Thursday of this week here, and obviously, generally speaking, they deal with a higher income consumer, and there's been a lot of talk about the K-shaped economy and how that might be obscuring things, the idea that there is a lot of spending going on, but it's being done by a much narrower cohort of folks, primarily at the higher income level.
Yeah, no, that's true. And if you look at really how the three majors in this country, they really have been focusing on the premium traveler and the international traveler, because that's where they make their profits. And that's where you're seeing big increases, in there. And so that's what's also going to be important to note tomorrow. If it does hold up in what we're seeing, the corporate spending, the high end, if that's really, holding up for them, and there's no reason why it shouldn't. But we're also going to find out they had the worst problems with the TSA, shutdown at Newark, and that's where United's hub is. So we're going to hear some color on that. Again, that will be short-lived. So even if that's, part of their earnings, it's going to be something investors will probably look through.
I don't want to get too much into speculation, but there's been a lot of talk about potential consolidation in the airline industry, whether it's United, American, JetBlue, and who is it, Spirit? I forgot Alaska. I forget. But it gets to this idea. Does that help them? I mean, I could sort of understand why you would want scale in this environment, but biting off a large company like that, particularly in this environment, is that actually going to help things?
Well, I think it doesn't help the consumer ultimately. And I think when you talked about United, sort of feeling the way about American, that seemed to be a non-starter. And you can't eliminate. You've got three big, it's about basically an oligarchy. And so the question is, the smaller one, the regionals, can they survive, without some cash infusion? Because you're seeing some of the lower costs, they're not making money, because those travelers, the K-shaped economy you're talking about, those travelers are not spending the money. They're under stress, they're under pressure. I mean, that group is always somewhat stressed, but it's been particularly so in this last last year or so.
All right, Barbara, great to have you. Got to get you back up for a longer conversation. Barbara Doran, founder and CIO over at BD8 Capital Partners. And be sure to tune in to Bloomberg Television tomorrow morning, where we will have an interview with the CEO of United, Scott Kirby. All right, we do want to continue our coverage here of the situation in Iran. In just the last few minutes, the President of the United States says that he will extend the ceasefire until talks with Iran conclude. Now, this latest extension coming just hours before the original deadline of Wednesday night was set to expire. A lot of concern was being raised about the fact that one of the lead negotiators, Vice President J.D. Vance, had not even left for Pakistan just yet. An Iranian official said they hadn't even planned to show up. Jonathan Lieber joins us right now. He's Eurasia Group's managing director and head of research. And Jonathan, I know there's a lot that we don't know yet at this point, but when we hear the president say until talks conclude, what talks are we talking about?
So there's ongoing back-channel talks between the U.S. and the Iranians, and there have been at least since the ceasefire began. And that's the talks he's talking about. I think that the meeting that we were expecting in Pakistan with J.D. Vance was largely symbolic, and I don't think it was likely that Vance was even going to get on the plane until he knew what type of agreement they were going to reach when he got there. And so right now, this delay is allowing for more exchanges of papers and more exchanges of ideas between the Iranians and the Americans that would then empower Vance to get on the plane, get over there, sign a deal, and say, you know, we have an agreement. So Trump's extension of this period is, yes, adding to the uncertainty, but I think it's also a very clear signal that the U.S. And the Iranians are both motivated to get a deal and aren't going to put their main guys in the room together until that deal is done.
And I do just want to point out for our viewers, I believe you can see it there on your screen. You're looking at SPY and the triple Qs there in the green here, S&P futures also pairing a good chunk of their losses from earlier in the cash session. And Jonathan, this gets to the idea here of progress. We talk about sort of these incremental day-to-day moves, but overall, are we in a much better position now here on April 21st than where we were a couple of weeks ago, where you had the president basically using rhetoric to seem like we were heading for a worst-case scenario?
You know, look, the president's use of rhetoric and his use of Truth Social is clearly designed to increase his negotiating leverage. The reason that he was making those Easter Day threats to Iranian civilization was to get the Iranians to capitulate. And it's been sort of successful. They got a ceasefire deal. The Strait is still not open, and it's unclear how they're going to get the Strait open. But I think from the perspective that there's no longer active bombs dropping, and it looks like the two sides are trying to de-escalate this, yes, we're clearly better off. But this issue of who's going to control the Strait, and then the long-term implications of the Iranians' willingness and ability to close down this Strait, and the Americans not being able to do anything about it using military force, I think is a much worse strategic outcome for the globe. And I would expect that risk premium to be priced into oil markets and other markets, at least for the rest of this year and probably beyond that.
Well, that's what I'm curious. I mean, a lot of folks we've spoken to on this program have said, look, even if we did come to sort of grand agreement in short time, it would take months to even get back to what we're considered to be the pre-war normal with regards to the energy and commodities coming out of the Middle East through the Strait of Hormuz here. Do you have a sense here that a lot of these companies, and for that matter, the producers of these materials, will try to find alternative routes first, or do you think they will try to seek a return through the Strait?
Yeah, I think what you're going to see going forward is a massive diversification effort away from Middle Eastern energy, Middle Eastern aluminum, Middle Eastern agricultural commodities. All the things that have been disrupted by this war are going to be with us for years to come. And that is probably going to mean an investment in green energy technology. It's probably good news for American energy exporters. It means that you're going to be looking for new, diverse ways to get energy out of the Gulf, going around the Strait. You know, I think you'd expect to see more pipeline development around Saudi Arabia, going into the Red Sea. And I think that's going to be a theme that plays out over the next several years that is really going to negatively hurt the economic outlook for the Middle East and create much more regionalized blocks of trade around all these things that are being disrupted out of here, because now we're coming out of this in a brand new world, in one in which we haven't been living for the last 40 years since the original oil crisis in the 70s.
John, really appreciate you taking time for us. Jonathan Lieber there, the head of research over at Eurasia Group, as we continue to keep an eye on headlines. The latest headlines, at least the one that seems to be moving the market, is the President Trump posting on Truth Social that he's extending the deadline for the end of that ceasefire. Balance of Power co-host Joe Mathieu joins us right now to walk us through exactly what we learned. A pretty lengthy Truth Social post, Joe. What's happening?
Yeah. Well, it appears to be an indefinite extension here based on what he's saying. I've directed our military to continue the blockade. That's clear. The Strait is not reopening this evening. And in all other respects, he says, remain ready and able, will therefore extend the ceasefire until such time as their proposal is submitted and discussions are concluded. The president likes to talk about breathing room. He appears to be buying himself some here at Romaine. Many folks thought of this evening as the deadline he had put out when it was a 2-week ceasefire. He told our own Jeff Mason yesterday that it was, in fact, Wednesday evening. And now we understand that we're going to be rolling into the future here without any real point of clarification. There was a back and forth for the last 24 hours, Romaine, about whether J.D. Vance had actually gotten on an airplane or not, with mixed signals coming from both Washington and Tehran. We had heard as well through reporting from Axios that the Supreme Leader had green-lit talks last night and J.D. Vance was about to get on a plane. None of this ended up happening. So it's unclear if bad information is being leaked or if we actually have a disinformation campaign between these two capitals to try to pressure their respective sides at the negotiating table. At some point, J.D. Vance, Steve Witkoff, and Jared Kushner apparently will find themselves back in Islamabad for another round of talks.
I am curious about the military side of this, meaning the U.S. blockade, at least as they're characterizing it. Have we heard from Pete Hegseth or any of the other folks in charge of our military as to where that stands?
I believe 27 is the number of ships we have so far claimed to turn around, actually forcing U-turns as they attempted to get through the Strait. We were reporting on Bloomberg overnight that there were 2 ships that have gotten through. And we, of course, know that we attacked an Iranian ship. It was a cargo vessel, not an oil tanker. By putting a couple of rounds through its engine room, we seized that ship, and it's unclear exactly what we will do now that we are in custody of it. But yes, the U.S. blockade continues. And, of course, the Iranians and some others had referred to this as a 2-sided blockade. Whether the Iranians are letting boats through is a whole other matter. But this is a piece of water that remains very quiet right now. And as you've already pointed out, we're watching oil prices move on this announcement.
All right. Joe Mathieu there, the co-host of Balance of Power. We're going to continue our coverage of this here on The Close, but you want to stick around after that at the top of the hour where Joe and Kelly Lyons will have a lot more information about what's going on in Washington with regards to the war. When we come back here on The Close, though, we're going to unpack this through the lens of the market reaction. We are seeing futures pare some of their losses from earlier in the session, but as far as treasuries, not a whole lot of movement. Greg Peters is up next. Back to the breaking news. President Trump extending the ceasefire until talks with Iran conclude. Those are his words in a Truth Social post, a self-imposed deadline that he had for Wednesday night. He says will be extended. And as you heard from Joe Mathieu just a little while ago, this appears to be an indefinite extension. Of course, a lot to parse, but the market is reacting. You see, at least when it comes to the equity space here, the knee-jerk reaction to the upside, but still a lot of concerns about the longer term. And you see that more reflected in a bit of Treasury yields holding at elevated levels. Greg Peters joins us right now. He's the co-chief investment officer of public and private fixed income over at PGIM. All right, Greg, let's talk about the move in yields. We did see a sell-off earlier in the session in treasuries, and that has kind of been the story here. A market certainly on the longer end of the curve that continues to price in higher yields for longer. What are they actually pricing in?
So I think the market is pricing in 2 things. The first is just this prospect of higher inflation. This is yet another supply shock. We're coming out of COVID. There's more inflation in the system today. There's concern about additional inflation in the system. So I think that's the first aspect. The second aspect is what we just call risk or /term premium. So investors, all else equal, are requiring more to own U.S. Treasuries, particularly out the curve. Mm-hmm. Why is that? That's a combination of the deficit. That's a combination of some of the policies, I think, and just the uncertainty component. And we are moving, albeit slowly, out of this, less dollar-dominant world, which all else equal, takes the shine off long-end treasuries.
What is the time frame that you look at when we talk about a less dominant, dollar-dominant world, as well as some of the issues with regards to the fiscal situation and the impact on yields? Is that a story for today, or are we talking, over the next couple of years?
It's a story for today that plays out over time. And I think the biggest concern around the deficit and those concerns is that you're not precisely sure when it's going to enact. But we know the preconditions are there, right? We know the deficit is quite large. We know the debt levels are quite high. We know that we're paying, over a quarter of our revenues on interest. So those preconditions matter. We just don't know when it will activate. And I think that is why the curve is steepening or the back end is underperforming, because of that uncertainty.
Is there a disconnect between what we're seeing in the fixed income space and what we're seeing in equities, or are they more in sync than we realize?
I think they're less in sync, but I think it's about tail risk. The equity market seemingly is, not really worried about the asymmetry of the tails. Fixed income is much more so, but at the same time, the markets have been incredibly resilient. If you asked me 3 months ago this scenario, would the markets be behaving the way they're behaving, I probably would say no. But there's a lot of underlying strength in the economy. I think that's playing out in risk assets. That's helping fixed income, and I think that matters. So what investors are really trying to do is they're trying to separate out, the signal from the noise, but more importantly, kind of the impact of what's happening with the war in Iran versus the fundamental strength that you're seeing through earnings and just the underlying economy.
I am curious, and when we talk about the underlying economy, this came up a lot during the confirmation hearing for Kevin Warsh for Fed Chair earlier today in the Senate. And I am curious as to how relevant, at least in the short term, and by that I mean this year, the Fed will be on rates, because I know there's a big debate here as to whether he'll cut, whether he'll not, but there's also now, it seems to be this parlor game that no matter what he feels, that the Fed will probably be in a bit of stasis for some time.
I mean, we're in this uncertain world. The Fed has to sit back and analyze it. So I just don't think they'll just blindly cut interest rates. I don't think Kevin Warsh wants to do that. I don't think he wants his legacy to be written that way. But I do think, all else equal, the bias is to move rates lower. So if there is an opening over time, if we get more clarity around the inflation picture, I think central bankers are looking at this as a supply shock. They're focused on labor, I think, more so than inflation at this point. I think the bias is to ease rates lower, but not dramatically. And I do think it'll be somewhat wait and see over the near term.
But when you listen to also his desire to shrink the Fed's balance sheet, how do you square the circle with this idea of maybe easing monetary policy on the rate side, but tightening up the balance sheet?
Well, he says over time, right? So I think the desire is over time. This is not a snap reaction. I think for markets to fear, balance sheet going, much lower over the near term and easing being in contrast, I think is missing the bigger picture, which is I think he has a desire to use the balance sheet in a more proactive way. And that means using it when you need it and taking it down. I think one of the mistakes that the Fed has made in the past is they've been too late and too long in terms of taking the balance sheet lower, and I think he's sensitive to that.
Do you think the market will push back on that? I seem to remember another Fed chief that came in with an intention of reducing that balance sheet, and the market gave him a pretty pointed message.
I think we're much better. We're in much better shape from a market function standpoint. So Treasury and the Fed are on top of the Treasury function and market function more broadly, and I think that helps a lot. But once again, we're not really sure what the right level is. I do think we're at adequate, ample reserves, but we won't know until we know. So it's a matter of reacting when needed, and I believe the Fed will do that.
Greg, great to have you here. Greg Peters is co-CIO of Public and Private Fixed Income over at PGIM. Here in the after-hours session, we are taking a look at the S&P futures up about 0.3% from where they closed in the cash session. As far as the individual movers, keep an eye on United Airlines off of its post-session lows, but still down about 0.8%. This after the company cut its full-year forecast because of rising fuel costs. Of course, that plays into the macro story, and we will keep an eye on that. Remember, we still have to wait for the conference call out of United tomorrow morning, as well as an interview right here on Bloomberg Television with CEO Scott Kirby. We'll We'll be back in a moment. This is The Close on Bloomberg. Welcome back to The Close. Joining us is a legend in the fintech space, out with a new venture at the intersection of AI hype and retail trading. He's the co-founder of Thinkorswim, as well as Tasty Trade, and is now bringing AI tech to the world of personal finance. LossDog, that's his new company. It uses the cutting-edge tech to calculate people's current professional worth and their potential net worth, and then show them how to achieve both. Tom Sosnoff joins us right here in Studio 2, founder and co-CEO of LossDog. Great to see you.
Hey, thanks for having me.
First, let's talk about the new venture. I can figure out my current worth, and I can maybe figure out my potential worth, and maybe see what that gap is. I'm not sure I want to know that. Maybe I do. How does that work? Yeah.
A lot of data.
Yeah.
A lot of data points, and a lot of historical data, and a lot of funky calculations, but LossDog was designed to give people context around their net worth or their value, because we have a fundamental belief that most people are underpaid over the course of their careers, and that's why we have this huge wealth gap. And in order to narrow the wealth gap, you can't mandate it, you can't legislate it, you have to do something special, and so we're trying to solve it through technology.
Well, when you look at the world of finance and how it's changed, and a lot of people now looking at the retirement space and the wealth management space as the next big inflection point, I think back to the creation of Thinkorswim, which is, I would just say arguably has become probably one of the most prolific trading platforms out there now, of course, under, TD, now Schwab. Schwab. What was sort of the impetus for that? And I guess my other question for you is, why did you sell it?
Well, it's funny. So, I mean, looking back at it, Thinkorswim was an amazing time in my life. I was standing in the S&P 100 pit in 1999, and I turned to a partner of mine and said, let's try something different. And we built Thinkorswim somehow. And it became kind of this cult firm, and it was an amazing piece of technology. And after 10 years, there were a lot of people interested in buying it, and we felt like, we're interested in trying something new. We like building stuff. And then we went out and built Tasty. I mean, the reason we sold it is because we were a public company, and multiple companies tried to buy us, and it was a nice win, I guess, and we thought, you know what, it's on to the next project.
I mean, how do you view kind of that rise of the retail trader? I mean, you mentioned Tasty Trade, which of course brought options to the forefront for a lot of folks that maybe weren't aware of them. How much has that changed over the years? And has it changed in a good way?
Oh, yeah. When we first left the trading floor to build Thinkorswim, 9% of the retail volume, notional volume, was traded in derivatives, options, futures options. When you look at the market today, it's about low 70s. So, I mean, the marketplace has exploded. We did 100 million contracts on Friday of options alone.
Wow.
I mean, these are insane numbers. We were doing 1 million contracts 25 years ago.
Are you still trading?
I only made about 100 trades today.
Just 100?
Just about 100.
So you must be loving kind of the volatility that we've been seeing in the market over the past few weeks.
Love it.
Yeah.
Love it. I mean, traders love uncertainty, they love fear, they love action.
Yeah.
There's a lot of action.
A lot of action. We actually saw that certainly with the big banks obviously showing up in their earnings. When it comes to the retail trader, or the individual trader, I should say, is there more risk in the system for those folks now? Or is it maybe a little bit more, insulated? Maybe that's not the right word, but you know what I mean.
Well, I think there's less risk today because for a couple of reasons. First of all, the markets are better, the fees are lower, and the technology is better. So the front end technology, you mentioned it, Thinkorswim, Tasty, I mean, every firm out there, the technology is incredible. And so individual investors like you, me, everybody, we have access to every single marketplace from a single platform. The risk is way down.
Yeah. When you look at the rise of prediction markets, do you see that as being a formidable competitor to, and I'm talking primarily in the financial space, not with sports and other stuff, a formidable competitor to the traditional trading platforms, a complement to that?
It's a complement, definitely.
How so?
Well, it's a tiny marketplace. I mean, the event-based marketplace, I look at it a little like the digital asset marketplace. I mean, I think it's probably at best a multi-trillion-dollar asset class, but it has a lot of market inefficiencies right now, wide spreads. It has very high fees. So I don't think it's a serious competitor yet. When all the high frequency firms get involved and they go exchange based, I think there's a better chance of it becoming a bigger competitor. But a binary marketplace is too one-dimensional for me. It's not strategic. So I don't see it as a long-term major player. I see it as a small-time player.
But even with some of those short-term contracts, the idea that people can make these ultra short-term bets in a way that, at least in this environment, has the potential to really pay off.
Oh, it's fun.
Yeah.
I mean, binary bets are fun, and they're liquid. They just have to be cheaper. In other words, the markets have to be tighter and the fees have to be lower.
And just, I do, before I let you go, I am curious about LossDog and just kind of the approach you're taking with it. A lot of people know you from Tasty Trade, but they know you from the live program that you did. You're actually doing this again with LossDog. Why?
Because I'm a sick human, and I love the pain. No, we have a show called One Lucky Dog. Yeah. We do it every day from 9 Central Time to 10, and it's myself, my partner Scott, and another woman named Sol Espinoza, and we do this fun show. We talk about careers, we talk about markets, and I guess I love talking.
Yeah, all right. Well,
like you, we're the same.
I do. It's a grind sometimes, but I love it. It's fun, and of course, I get to meet great people like you, Tom. Real pleasure, a real treat to meet you here. Tom Sosnoff, there, of course, the founder of Thinkorswim, the founder of Tasty Trade, and now the founder of LossDog. When we come back, we're going to talk to another legend in the science space, Bill Nye, the science guy. We had a chance to catch up on him. He's out there on Capitol Hill battling what he calls an extinction-level funding cut to NASA. That conversation coming up after the break, right here on Bloomberg. All right, the President of the United States proposing a record-setting budget for the U.S. military. But for the U.S. Space Agency, NASA, it's facing renewed funding pressure, and this actually comes just days after the historic spaceflight of Artemis II. The White House asking Congress to cut NASA's science budget by about half. This is a chorus of astronauts and scientists sound the alarm on what that could actually mean, not so much for the agency, but really for progress in the scientific space itself. We had a chance to catch up with Bill Nye, the science guy, ahead of a meeting that he was going to have with lawmakers on Capitol Hill about this issue. Take a listen.
We're on Capitol Hill, 130 people here in the U.S., reminding members of Congress and the Senate that the modern word is a disconnect between what people expected and what has the president's budget request, which in the states we call the PBR, wants to cut the NASA budget 20% and cut NASA science, as you pointed out, almost 50%, 48%. And the budget as presented is full of typos. It refers to the fiscal year 2026, which would be last year. It's how to say, a lazy document. And why it's created that way is a little bit of a mystery, but it is an irony and a bit of a slap in the face. These astronauts just accomplished this remarkable thing, and now they want to cut the budget.
One particular aspect of the budget that you are focusing on is this Science Mission Directorate. I think as of right now, it's about 30% or so of NASA's total budget. I want to know if you can articulate exactly what that does. And with regards to the types of technologies and research that comes out of this, is this just done for our own ego, or are there practical applications of that science for everyday people?
Well, if you ask people in the U.S., ask people around the world, what does NASA do? People say NASA does science, does the scientific exploration of space. And as far as what are going to be the practical applications, the answer is absolutely, without question, we don't know. That's the whole idea. One of the founders of the Planetary site, Bruce Murray, who was the head of the Jet Propulsion Lab in the heyday of the Voyager missions and the Viking missions, the first landers on Mars, he pointed out that people asked him, what are you going to find when you explore these other worlds? He said, we don't know what we're going to find. That's why we're exploring. So we remind everybody that China National Space Administration is going wild, doing extraordinary things in space. A lot of smart people working very hard in China. They're going to put people on the moon in 2030. They are sending missions to the outer planets. They're planning a mission beyond the heliopause, where the particles streaming off the sun run out of momentum. Yeah. And so by not competing, the United States would be conceding the lead to other space agencies, which I don't think is what anybody wants.
And so we're talking about the White House's fiscal year 2027 budget request, which would take NASA funding from $7.25 billion to $3.9 billion. To go from 7.25 to 3.9, what is cut if you do see that scale of a reduction?
So if you're asking me, and I got the impression you were,
I am.
It's 53 missions, 53 space missions. These are spacecraft and the ground support systems and the staff that run the spacecraft and collect the data and process it. 53 missions would be cut for a cost to U.S. taxpayers, a waste, a throwing away of about $13 billion. $13 billion squandered, just tossed in the budget trash can with these proposed budgets. And that's why Congress, members of Congress and the Senate from every state just shrug their shoulders, shake their heads. Yeah. We're not going to allow this. We're going to push back. NASA has its reach into every congressional district in the U.S. Every taxpayer has an interest in NASA. And every taxpayer has an interest in NASA science, because that's where the discoveries are made. And I just remind everybody, we are on the verge of making discoveries here in the solar system that will change the course of human history. It's very reasonable that what we have found in these rocks on Mars are evidence of ancient life. We need to bring the rocks back to Earth, to bigger laboratories with big, real-time, heavy, huge instruments to study them. We have a mission, as you may know, on the way to Europa, the moon of Jupiter, with twice as much ocean water as Earth. We are on the verge of extraordinary discoveries. And so to be canceling or trying to cancel 53 missions, 53 budget line items right now is odd at best, and we are here to ensure that it doesn't happen.
I am curious, though, Bill. I mean, some of the folks in Congress would argue that the private sector has picked up the mantle of some of this. I was watching Blue Origin finally land their reusable rocket relatively successfully. There are people that look at the progress that SpaceX has made and says that private industry can help carry the U.S. space program much further than a completely government-led or government-run space program. What do you make of that?
Absolutely true. But note well the two different things. Buying trucks is not the same as buying the cargo on the truck. So the rockets are good. Lowering the cost, especially of getting to low Earth orbit, is good. Lowering the cost of sending payloads on the order of 2 or 3, 4 tons to the moon is good. But that's not what NASA science does. NASA science does unique missions with unique one-of-a-kind instruments. Well, unique one-of-a-kind. Unique instruments that make extraordinary discoveries on other worlds and the space in between. Two different things.
And that is Bill Nye, the science guy, the chief ambassador over at the Planetary Society, talking about the potential for budget cuts over at the U.S. Space Agency, NASA. Let's set you up for what to watch over the next 24 hours. We should point out we got earnings out of United Airlines after the bell. Those shares are now higher in the after-hours trade. We're going to hear from Boeing tomorrow morning. We're also going to get results out of AT&T and GE Vernova. And then post-market, keep an eye out. Tesla, IBM, ServiceNow, Lam Research, Texas Instruments, Southwest, and Kinder Morgan, all set to report after the bell tomorrow, all potentially market moving. We're also going to get some economic data, if you will, a focus on mortgage applications with the latest data out of the MBA. That's going to come at 7 a.m. Eastern Time, and at 10 a.m. Two hearings on Capitol Hill to keep an eye on. The Treasury Secretary, Scott Bessent, he's set to testify on the president's budget request, and we're going to hear from the U.S. Trade Representative on the 2026 trade policy agenda. We'll be back tomorrow right here on The Close on Bloomberg.